The core AML framework starts with the firm-wide risk assessment, or FWRA, the AML policy, the client due diligence policy, the matter risk assessment form, the Criminal Finance Act policy, and the source of funds policy. You also need to be fluent in the firm's key abbreviations. That includes MLRO, HOLP, HRTC, FATF, CMRA, CFA, and MLTF, because auditors may expect you to recognize the language used across policies, forms, and reporting routes. In practice, these documents and terms work together. They guide how you assess risk, identify clients, verify funds, escalate concerns, and evidence that your file is audit ready. Alongside the main AML policies, the firm also relies on supporting policies covering accepting and declining instructions, ceasing to act, anti-bribery, corruption and fraud, client care, mortgage fraud, and acting for both sellers and buyers. You should also be aware of the linked controls on property fraud, vulnerable clients, whistleblowing, complaints, data protection, file opening and closure, and grievance procedures. Together, these policies shape how risk is managed from file opening through to closure. The firm supports compliance through a set of registers and forms, including the AML Central Risk Assessment Folder, the Internal Suspicious Activity Report, the Company's House Discrepancy Register, the Conflict of Interest Record, and the Declined Instructions Register. You should also know the Firm and Staff Interest Register, the High Risk Matters Register, the Undertaking Register, training logs, the Annual Compliance Declaration, and the Training Feedback Questionnaire. These records help demonstrate oversight, escalation, and continuous training. Money laundering is the process of making criminal property appear legitimate. In conveyancing, that risk matters because property transactions can be used to move, hide, or legitimize funds from crime. The three classic stages are placement, layering, and integration. Placement introduces dirty money into the financial system, layering moves it through transactions to obscure its origin, and integration brings it back looking apparently clean, often through assets like property. Under the Proceeds of Crime Act 2002, criminal property can be confiscated or recovered, and the law creates money laundering offences that matter directly to legal work. The legislation also underpins the duty to report suspicious activity where required. The three principal POCA offences you should remember are concealing, arranging, and possession. In practice, that could mean hiding the origin of funds, becoming involved in a transaction that facilitates the use of criminal property, or holding criminal property in any form. For fee earners, the key point is that routine legal work does not remove risk. If a property matter helps criminal funds enter or move through a transaction, the conduct may engage POCA even where the transaction looks ordinary on the surface. If you work in the regulated sector and know, suspect, or have reasonable grounds to suspect money laundering, you may have a duty to report. Suspicion does not require proof. It can arise from unusual facts, inconsistent explanations, or patterns that do not make commercial sense. At firm level, concerns are reported internally to the MLRO. That internal report allows the MLRO to assess the information, decide whether further inquiries are needed, and determine whether disclosure to the NCA is required. You must also remember two offences that auditors often ask about. Failing to disclose can itself be an offence, and tipping off is strictly prohibited. You must never alert the client or any third party that a suspicion or report exists. When you need to make an internal SAR, submit it to the MLRO, and if the MLRO is unavailable, refer the matter to the HOLP. Mark the email strictly private and confidential, and follow the firm's red and green banner process. Never save a SAR to the matter file. Once the concern is raised, pause work until permission is given, because continuing a transaction without clearance may create legal and regulatory risk. The MLRO will review the report, make any necessary inquiries, disclose to the NCA where appropriate, and ensure records are retained for 5 years. Your role is to escalate promptly, protect confidentiality, and wait for direction. The 2021 LSAG guidance reinforced a stronger risk-based approach across legal practice. That means greater emphasis on the firm-wide risk assessment, the matter risk assessment, and tailoring due diligence to the actual risk presented by the client and transaction. The guidance also sharpened expectations around high-risk third countries, enhanced due diligence, beneficial ownership, source of fund scrutiny, technology and cyber risks, sanctions compliance, and the responsibilities of the MLRO. For audit purposes, another important shift was better documentation. Firms are expected to evidence our decision-making more clearly and show how risk assessments and controls operate in practice, not just on paper. In March 2023, LSAG guidance was updated to address proliferation financing more directly. Proliferation financing involves funds or financial services connected to the development or movement of weapons of mass destruction. For fee earners, the practical point is to recognize higher risk clients, entities, jurisdictions, and transaction patterns that could indicate exposure. That includes unusual ownership structures, sanctioned links, and transactions with limited commercial rationale. The firm must assess its proliferation financing exposure, apply controls, document the assessment, and train staff. So this is not a separate theoretical issue. It is part of everyday AML risk management and audit evidence. Under Regulation 18 of the Money Laundering Regulations 2017, the firm-wide risk assessment identifies the firm's exposure to money laundering, terrorist financing, and proliferation financing risks. It is the foundation of the firm's AML control environment. It sets out the risks the firm faces and the mitigations the firm applies. That includes how client due diligence and enhanced due diligence are triggered, how sanctions and jurisdiction checks are approached, and how higher risk matters are escalated. It also underpins staff training, internal reporting mechanisms, and the consistency auditors expect to see between policy, file activity, and management oversight. A high-risk jurisdiction is a country or territory that presents increased money laundering, terrorist financing, sanctions, or proliferation financing risk. The firm uses FATF publications, UK sanctions lists, and HM Treasury notices to identify those risks. The firm's position is cautious where clients are based abroad or funds come from higher risk jurisdictions. Director approval, enhanced due diligence, and MLRO sign-off may all be required before work can proceed. The policy is especially clear on Russia. Russia is treated as high risk, and the firm does not permit acting where clients or funds come from Russia. You should also be aware of the December 2023 jurisdiction list update referenced in the training document. For audit answers, make the process explicit. Identify the jurisdiction risk, check the current lists, apply enhanced due diligence, escalate internally, and do not proceed unless the firm's approval requirements are fully met. If a country, person, or entity appears on a sanctions list, legal and financial restrictions may apply immediately. For the firm, that means sanction screening is not a box-ticking exercise. It is a live control that can stop a matter in its tracks. If a client is identified on a sanctions list, suspend work straight away. Do not inform the client. Contact the MLRO immediately and send an internal SAR without delay. If funds are held in client account, preserve them and seek OFSI guidance. You also need to check whether a sanction actually applies, including where a client lives in the UK but has links to a sanctioned country. In those cases, enhanced due diligence may still be required and an OFSI license may be needed before certain steps can be taken. The safest audit-ready answer is to show that you would screen, verify the match, stop work, avoid tipping off, escalate to the MLRO, and follow OFSI requirements before any further action. From the 28th of January 2026, the UK sanctions list becomes a single authoritative UK sanctions list. That means firms must treat the UKSL as the main reference point, while the OFSI consolidated list will no longer receive updates. In practical terms, electronic ID and sanctions screening processes, AML policies and procedures, and any manual counterparty checks all need to reflect that transition. Staff should not rely on outdated list references after the change takes effect. One important exception remains. You still need to check the separate Russia financial restrictions list because that sits alongside the UK sanctions framework and remains relevant to risk assessment and compliance decisions. If you need the official source, use the gov.uk sanctions list page. In practice, the audit point is that your screening route, policy wording, and file checks must all align with the UKSL from late January 2026 onward. Since November 2025, the firm has required OFSI checks on all sale files and on files that receive funds from third-party solicitors. That means the check is not limited to unusual matters. It is part of routine file compliance where those triggers apply. You must save a screenshot of the buyer search result to the file as evidence. That screenshot should be retained on the file checklist, so the file shows not just that a check was done, but what the result was and when it was captured. For audit purposes, missing evidence can be treated as a missing check. So if the requirement applies, the screenshot needs to be on file and easy to locate. A politically exposed person, or PEP, is someone entrusted with prominent public functions, and the category can include domestic PEPs, foreign PEPs, and individuals connected to international organizations. Family members and close associates may also create related risk. PEPs are treated as higher risk because their position can create greater exposure to bribery, corruption, or misuse of funds. That does not mean the firm can never act. It means risk must be identified early and handled through the correct approval and diligence route. Where the policy requires it, matters are referred to the MLRO and enhanced due diligence is applied. The firm makes an important point here. It applies the same level of EDD to all PEPs, whether domestic or overseas. A strong audit answer is to say that you would identify the PEP relationship, escalate as required, complete enhanced due diligence, obtain the right approval, and document the rationale for continuing or declining the matter. The firm's source of funds and source of wealth checks are grounded in legal obligations, including Regulations 28 Sub-Regulation 11A and 35 Sub-Regulation 5B of the Money Laundering Regulations 2017. These checks are not optional extras, they are part of required due diligence. Source of funds means the specific origin of the money used in the transaction. Source of wealth means how the client built their overall wealth more broadly. Auditors often test whether fee earners can explain that difference clearly. The training also refers to the mental elements relevant to offences under Section 7 of POCA, so staff should understand that knowledge, suspicion, and awareness of risk matter when handling funds and deciding whether to escalate concerns. The firm has a clear approval threshold as well, where source of funds and wealth exceed £150,000, supervisor approval is required. That threshold must be recognised and applied consistently. For source of funds, evidence must match the explanation given. If the money comes from a property sale, inheritance, a policy or pension encashment, shares, savings, or a loan, you should obtain documents that clearly trace the money from that source into the transaction. The same principle applies to the sale of high-value items, funds received from outside the UK, dividends, and gambling winnings. The question is always whether the records genuinely explain where the money came from and whether that explanation is credible. Where money or documents come from abroad, extra checks may be needed. That can include verifying lawyers, obtaining translations, arranging notarization, and completing sanction screening where the jurisdiction or parties create added risk. The audit-ready approach is to gather enough evidence to trace the funds, test whether the documents fit the narrative, and escalate if the explanation remains unclear, inconsistent, or too weak for the level of risk involved. For companies, start with the Companies House search and confirm authority to act. Review the persons with significant control. Check who owns or controls the business and make sure the instructions are being given by someone properly authorized. You may also need audited accounts, the shareholding structure, details of any trust arrangements, identification for beneficial owners, and board resolutions where the matter requires evidence of authority or ownership. Source of funds and source of wealth still matter for companies, especially where ownership is layered or complex. Enhanced due diligence may be needed for higher risk structures, and sanctions and PEP checks should be completed on beneficial owners and key directors. In other words, you are not just checking the company name, you are identifying who is behind the entity, who controls it, where the money comes from, and whether anything in the structure raises a red flag. Conveyancing red flags include large cash payments, overpayments, unexplained payments, third-party payments, payments in tranches, and pooled funds. Each of these can indicate that the funding story does not match the transaction on the file. You should also pay attention to high-risk business sectors, non-institutional lenders, and situations where private expenditure appears to be funded through corporate assets. These can point to fraud, concealment, or misuse of funds. The wider message is to look for anything unusual, commercially odd, or poorly explained. If the pattern on the matter does not make sense, treat that as a risk signal rather than brushing it aside. Auditors may ask you to give examples, so be ready to speak about unexplained third-party funding, irregular payment structures, and transactions where the client's explanation does not line up with the documents provided. When a red flag is identified, the first response is not to ignore it or rush ahead. You should carry out enhanced due diligence, scrutinize inconsistencies carefully, and verify information that does not yet stand up to proper review. If you identify a red flag, stop and treat the matter as higher risk straight away. Carry out enhanced due diligence, ask for further identification, and request extra documents, including proof of funds and source of wealth. Then scrutinize the client's explanation carefully, especially where there are inconsistencies, gaps, or anything that doesn't fit. You also need to verify the other side's solicitor on the Law Society or CLC register, escalate the matter internally to the MLRO, and document both the issue and the client's responses in full. Consider whether an internal SAR is required, avoid tipping off at all times, and where the concern affects the transaction, notify the mortgage lender if applicable. If suspicion still can't be resolved, the firm must refuse to act or withdraw. Our firm's policy on crypto assets is simple. We do not accept cryptocurrency. Any instruction involving crypto must be declined. And if crypto is discovered after a transaction has already started, the matter must be referred to the MLRO immediately, and no further work should be undertaken. Electronic money institutions also carry elevated risk. The CLC's March 2024 AML sectoral risk assessment warns that EMIs require careful scrutiny and that many suspicious activity reports involve the electronic payment sector. So if funds are coming from an EMI, we need to examine them closely and make sure the payment route makes sense for the transaction. That sits alongside the core CLC, AML, and counter-terrorist financing code requirements. The firm must maintain effective AML systems, carry out customer due diligence for new and existing clients, including beneficial owners, ensure transactions fit the client's economic position and lifestyle, operate robust verification systems, and keep those controls under regular review. We identify politically exposed persons through electronic screening and manual checks. If a client is a PEP, including a domestic UK PEP, the matter moves straight into enhanced due diligence. That means carrying out deeper checks into source of wealth and source of funds, then escalating to the MLRO for approval before we proceed. The decision must be documented, and the matter must stay under ongoing monitoring throughout the transaction. When the MLRO receives an internal SAR, they acknowledge receipt, review the matter urgently, and provide an update within 24 hours. That update confirms whether the fee earner may proceed or whether further action is needed, including an external SAR to the National Crime Agency. Record keeping is just as important. The internal SAR must be retained securely by the MLRO in the firm's Suspicious Activity Register. No copy should be kept on the client file or anywhere else, and all records must be maintained confidentially in line with AML regulations. All relevant staff must receive training on the money laundering regulations, the firm's AML and counter-terrorist financing policies, and how to identify and escalate suspicious activity. That training is there to make sure risk is recognized early and handled consistently. Following the latest legal sector affinity group guidance, the firm-wide risk assessment was reviewed and updated to reflect the April 2025 changes. The firm now applies the revised beneficial ownership definition of more than 25%, aligns high-risk third countries with the current FATF lists, strengthens checks on third-party source of funds, especially gifts and family contributions, and requires overseas entities to be properly registered before proceeding. Fee earners have also been updated on these changes, and the revised approach is reflected in matter risk assessments, so the new requirements are built into day-to-day file handling. When you're asked about risk assessment, the key point is that it starts as soon as the file is received and continues throughout the transaction. In conveyancing, we are alert to money laundering risk and Criminal Finance Act risk, and we mitigate that through client due diligence, source of funds checks, matter risk assessment, supervision, and escalation where anything does not fit. No work starts until identification and the initial checks are complete, and electronic ID is completed at the outset as part of onboarding and risk assessment. Fee earners should also be ready to explain the key messages from LSAG guidance, especially the need for proportionate risk-based controls, proper due diligence, and ongoing monitoring. For the April 2025 LSAG changes, be ready to cover the revised beneficial ownership threshold, high-risk third countries, third-party funds, supply chain risk, overseas entities, domestic PEPs, and the economic crime levy. Keep your answers concise, specific, and tied back to what you actually do on the file. If electronic ID returns a PEP or sanctions warning, that result must be reviewed immediately and recorded on the matter risk assessment and the client due diligence record. For gifted deposits, we verify the donor's identity, obtain source of funds evidence, and make sure the gift letter is on file. The firm can act for domestic and foreign PEPs, but only with enhanced due diligence, MLRO approval, and ongoing monitoring. If you suspect fraud or money laundering, stop, escalate internally, and do not proceed or tip off the client once suspicion arises. Staff are trained on the regulations, firm policy, suspicious activity escalation, and current LSAG expectations. High-risk country matters require enhanced scrutiny, and in our firm, a high-value transaction is any matter where the value or funding profile increases the AML risk and requires extra care. For repeat clients, AML procedures still apply and due diligence must be refreshed where required. Third-party requests for file information, including police inquiries, must be handled through firm procedure and not answered informally. Vulnerable clients may need additional checks to confirm understanding and protect against undue influence. Fee earners should also be ready to explain source of funds versus source of wealth, how high-risk country matters and overseas entity transactions are checked, and the red flags conveyancers look for. The key message is simple. Follow firm policy, escalate concerns promptly, document your decisions, and be ready to explain your actions to an auditor.